Hey guys, happy Sunday, July 27th. We're talking GameStop discounted cash flow again. Some of you guys had asked if I would share my spreadsheet with you, and I've got something even better for you, a free web-based tool that you can use to calculate discounted cash flow on GameStop or any ticker that your heart desires. And because discounted cash flow can be a little bit difficult if you're not familiar with it, I'll spend just a couple minutes with you today showing you how to set up this web tool, and you can do your own modeling to your heart's content. While we're here on the stock chart screen, let's just talk about a couple of things real quick. I am long on GameStop. I am waiting for volatility to pick up so that, we can hopefully retest that upper supply zone at some point, maybe closer to earnings, which will be first, second week of September. So that's kind of what I'm waiting on. Maybe we get some news from GameStop that they invested their cash, although that is not something I'm counting on in the short term. Just sitting back, being patient. On the daily chart here, we have a death cross, but we do have a low RSI. And when we compare the chart to the weekly, a little bit better scenario, a golden cross on the weekly, again with low RSI. So if you're a longer term trader like I am, at least for the moment anyways, because I'm waiting for the price action to move up closer to that supply zone, I guess I'm going to be a longer term trader for this swing that I'm in. I'm going to be looking at the weekly golden cross. The daily chart tells me that we might have some negative price pressure, and that's fine. If the price gets pushed down into this demand zone, that's where I really like to do my buys. And my cost average is just around 21.61 right now. So were I given the opportunity to add a little bit cheaper, that would be fine with me. So our shorter term traders might be looking at the daily chart or an hourly. Longer term traders, I'd say the weekly chart still looks pretty good, and GameStop will be a news-driven ticker. News that the company did something with its cash, or news about a better than expected Q2 once we get those results in 5-6 weeks. Now let's move on and talk about the discounted cash flow tool, and I'll put a link to this website in the video description, and go play with this tool to your heart's content. Learn how discounted cash flows work, because this is how professionals value stocks. One tool of many to understand what a stock is worth. What should the price be out there in the market? The website we are going to be using today is called alphaspread.com, and up at the top here there is a DCF calculator under the tools bar. And just go ahead and click on Tools, then DCF Value Calculator. Once you are on that part of the tool, type in the ticker that you want to explore, and we can get the DCF calculator up. And then we're going to need to modify some settings, because you're probably not going to like the default number that it shows us here, 393. And we need to update some things, and that's what we're going to talk about in this video, how to set up a DCF model for GameStop. There are some nice educational hyperlinks here where you can go read a little bit more if this topic is still new to you. What is DCF? How is it calculated? There are some read more links down at the bottom of each of these boxes. But one thing that I want to point out here on this initial screen is the operating model. In this operating model box, there are 4 different models that you can choose from, and I would recommend that you use a standard DCF model, which would be FCFF. That would be via free cash flow to the firm, and you'll see that DCF value in the top right change when I select the proper DCF model. Goes up to 1350, and now we're going to go in and change some of the assumptions that AlphaSpread is using, and you can put whatever assumptions you want in here to generate different DCF fair values, so that we can have this model show something similar to how I have my spreadsheet set up, I'm going to first set the assumptions here at the top. We want a 5-year forecast period. That is already the default. For the discount rate, I'm going to put 11%, just like I did in my spreadsheet. You could use a different number, but make sure you understand what a discount rate is before you start going in and modeling different scenarios. And in my spreadsheet, I had the terminal growth rate at 0%, although you could bump that up to 1 or 2% if you wanted to. Just for this video, I'm going to keep it at 0% like I had in my spreadsheet. The next thing that we want to make sure we like the numbers or not. If we don't like them, we change them. Here on the model would be the revenue and the operating margin. And I see some things that we need to change here on these. You can use your own numbers, or you could go to analyst forecast for revenue expectations. The analysts have 3.5 billion, 3.18 billion the next year, and 2.53 billion in 2028. Let's see what this model has. 3.5, 3.18, 2.5, 3.5, 3.105. Let's make this one 2.5, and then I'm just going to keep it flat. Let's assume that by that point in time, GameStop has no more store closures. If you want to model growing revenue, you could go in after year 1 or year 2 and start increasing the revenue, and that would give you some different results as well. That is the beautiful thing about having a model. You can lay out different scenarios and see how each one of them impact fair value, and that is what the professionals do. We're going to click save on that. We don't need to change the growth rate. It'll automatically calculate it because we put in an absolute value. And the next thing that we want to look at is the operating margin. I think the numbers here on the base case are too bearish, so we'll go back over to stockanalysis.com just to pull some profit or operating margins. We got 3.37 in the most recent quarter, 5.96 in the quarter before that, and on trailing 12 months operating margin, we have 1.58. I'm going to go with the most optimistic of these 3 numbers, and some of y'all might not like that if you're very bearish on GameStop. If you're very bullish on GameStop, you might want to go even higher, but let's go with 5.96% for this year on the operating margin instead of negative 2.09%. And let's say that GameStop gets 1% better on operating margin every year for the next 5 years, just as an example. 8.96 and then 9.96. Finally, here in the far right column, the terminal value for operating margin, let's make that the same as year 5, 9.96. And once we hit save, we should see an update on the DCF value, but we do have a couple of other variables down below that we need to update as well. The next variable we need to input is taxes, and in my spreadsheet, what did I have for? I had a tax rate of 5.79, which gave ranges of $7 to $5 million. Let's look on GameStop's most recent, well, trailing 12 months, $12.8 million trailing 12 months, 5.9 in fiscal year 2025. Like I did here in my spreadsheet, let's use some numbers closer to what GameStop had for the most recent 2 full years. I had 7, 6.5, 6, 5.6, 5.2. Let's input something close to these numbers. We'll input taxes at 7 million, and then we'll just decrease it $500,000 as the revenue falls. And then I have flat revenue the last 3 years, so I'm going to keep taxes flat. And then we'll hit save. The next input is CapEx. These numbers are way too high, so we need to change that. You can find CapEx on the cash flow statement. And for GameStop in the most recent year, negative $14.1 million, $14 million expenditure on CapEx. So let's just use that, and we'll assume that CapEx stays relatively flat for the next couple of years. You could drop it $1 million or so if you wanted to. and we will click save on that. And that is all of the variables that we need to change. We are getting a discounted cash flow value with these numbers of $16.21. How does that compare to my model? Actually a little bit better, but very close. I had $15.59. This has $16.21. Basically the same number. I just want to interrupt and clarify the reason that there is a slight difference between my spreadsheet model and this one. If you recall, on my spreadsheet, I modeled declining revenues for 5 years in a row, whereas in today's example, we did a slight decline for the first 2 years, a slight decline for year 3, and then flat after that. And so that gives us a slightly better outcome than the video that I showed you guys a week or so ago. And if we scroll down, they walk you through how the calculation works. There are some other sensitivity tables similar to what I had for you guys in the bottom right of my spreadsheet, where you could look at how changing revenue growth would affect the fair value. We have a negative revenue growth rate right now. So you'd have to have a 20% revenue growth rate to get to today's price level on GameStop. We're not anywhere close to that. The company's closing stores, so we're not going to model a growing revenue. But we could make some assumptions about operating margin improving, and that is the next sensitivity table it looks like here. It looks like that if GameStop had an operating margin of 23% or higher, you would be fairly valued at today's price, around $23 or $24 out there in the market. But any operating margin below that is still going to yield a DCF fair value below today's current price. The other thing you could change would be the discount rate. These sensitivity tables let you see all of the results without having to go in and reprogram all your numbers up there on the top. What would the results be if we didn't consider GameStop as risky as a 11% discount rate, which is what we input at the beginning of this video? If you dropped the discount rate all the way down to 4%, 5%, you'd be closer to today's fair value, and that is a debatable point. Make sure you understand what a discount rate is and why we choose a certain number, and make sure you understand why I'm choosing 11%. And feel free to model whichever discount rate you want, but be able to defend it. There are some other tools at the very bottom, including relative valuation, profitability analysis, solvency analysis. Maybe we'll cover those on a different video. I just wanted to get this Alpha Spread DCF calculating tool in your hands so you can kind of play with it. Keep in mind that Bitcoin is not included in a DCF model because it's not throwing off cash. It could impact the income statement, but it's not going to impact cash. We can't discount it. So it is not included in a DCF model. If you want to see a model where I added in Bitcoin, go watch my video on the GameStop sum of the parts, where we can include Bitcoin and give it some value. Remember, the exercise of doing a DCF model is to understand how Wall Street is looking at the fair value of GameStop, and quite likely management, so that you can understand as the price drives up, 20, 25, 30, 35, the higher it gets, the farther away from fair value that it gets, the more likely that it is to be shorted or for the company to take advantage of that wide discrepancy from fair value to sell more shares into the market. That would be the smart thing that any company would do. When your stock is trading far above fair value, you want to sell shares. When your stock is trading far below fair value, you want to buy back shares. That is why it is useful to understand what fair value is. It could help your trading if you are not a buy and hold forever. I know one or two of y'all plan to never sell, but I'm trying to make profits, and I swing trade GameStop. So this is a vital part of my analysis. Maybe you'll find it useful. Maybe you'll absolutely hate it, but it doesn't change the fact that all of the professionals out there use it. This is basic stuff taught in any business school at a freshman or sophomore level. If you guys have any questions or comments, let me know down below. Thank you for watching all the way through. I am Tony Denaro, and I will see ya on the next video.